Hi, everyone. This is Darrell from the WealthSpire investment team. We hope you're all enjoying your spring and gearing up for the summer months, but we wanted to circle back with you all for another edition of our Markets in 2 Minutes series because there's been a lot going on in the bond market the past month or so, and we wanted to provide a quick recap and begin setting the stage for what investors should be thinking about going forward. So we've been discussing bonds a lot with our clients recently, mostly because yields are at such attractive levels. But we did experience a pretty difficult month in the bond market back in April, with core bond market indexes experiencing at least a 2.5% decline, and bank loans being really the only bond asset class that were able to produce positive returns. The main reason for this was that we had some inflation data come in higher than expected. And so in response, the bond market collectively reassessed its expectations for how the Fed will react going forward. And we came into the year with markets really expecting that the Fed would be able to start cutting rates pretty early on in 2024. And markets have now come to the collective realization over the past 4 months that that's not something that's likely to happen until the end of the year, if it even happens at all. In April alone, we saw about 40 basis points of implied rate cuts get removed from the market's expectations. And anytime that happens, you're going to see a reset of yields across the curve. And in this case, that led to these negative returns. This chart here shows the number of rate cuts that are priced into the bond market at any given point in time, and it's a great visualization of what I just described. As you can see, really since the beginning of 2024, the market has been steadily decreasing its expectations for future rate cuts. And at this point, the market's pricing in about 2 cuts by the end of the year, down from as many as 7. The good news is that bond investors are still able to clip a healthy amount of coupon income to serve as a primary source of returns going forward. And this is definitely something you'll have heard us preach in previous updates to this video series because it really comes down to patience at this point, and it's a point we've been trying to drive home. Because if you look at this next chart, we're showing bond market returns through May 5th of any given calendar year, and then where the market ultimately ended that year. And you can see that what we've experienced this year to date is not necessarily out of the ordinary. 2022 was obviously a massive outlier and in many ways was just a historic year across the board and a generational event in fixed income. But this year comes nowhere close to that. And in fact, there have been several instances of similar drawdowns in the bond market through this point in the year. And in many cases, bond markets actually ended that year higher. And so our message to investors right now, who have largely had a rough go of it in the past couple of years in fixed income, is to hang in there. We are now at a point where you are collecting a nice stream of income on your bond portfolio that in most cases is above the rate of inflation. And so it's all about patience going forward and allowing these favorable levels of yield to begin compounding in your favor. Because you have that income coming in, you don't need to have prices move in your favor in order to generate positive returns. Of course, we will continue to keep tabs on all of this as things evolve, and we'll be back in a few short weeks with another update.